FSM1 webinar with Affin Hwang Asset Management this evening. I'm Rushi. I'm from the FSM1 Investment Marketing team. So before I introduce our speaker, please allow me to make several announcements first. Okay, so first of all, kindly mute your mic, okay, for a better audio experience. Also, we will be temporarily closing the chat room, okay, for now, and we will resume it back during the Q&A session after the presentation. Okay, so if you have any questions, feel free to type them in the chat room during the Q&A session after the presentation. Also, throughout the webinar session, if you are experiencing some audio issue, you can try to rejoin the webinar. If you rejoin the webinar and you're still experiencing the same audio issue, you can email us at investhelp.my@funsupermart.com for the recording, and we will send to you, okay, via email. Okay, so with the above few announcements, allow me to introduce our speaker for this evening. Okay. Our speaker for this evening is Mr. David Ng. He's the Deputy Managing Director and also the Chief Investment Officer at Affin Hwang Asset Management. So Mr. David Ng joined Affin Hwang Asset Management in 2002 as Head of Equities and assumed the role of Chief Investment Officer in September 2006. In January 2018, he was made Joint Deputy Managing Director while retaining his position and responsibility as Chief Investment Officer. He graduated with a double degree in Bachelor of Commerce Accounting and Bachelor of Law from Monash University in Melbourne, Australia, and is also a Chartered Financial Analyst Charter holder. Okay, the task of today's presentation this evening, his title is When the Going Gets Tough, the Tough Gets Going. Okay, I will pass the mic over to Mr. David Ng to proceed with his presentation.
Hello, evening everybody. Thanks Rushi for the introduction, and I hope everybody on this call is staying safe, all locked up at home, but staying safe nonetheless. Thank you so much for taking your time out. It's dinner time for most of you. Thanks for taking your time out to listen to what we have to say about how we are navigating through this current difficult period in the investment world. By way of background, what I would like to share with you is for the funds that Affin Hwang Asset Management manages internally, leading up to this accelerated sell-off that we saw in the last month or so, we had already decided to raise ample amount of cash for the funds that we manage. And we've been maintaining a fairly defensive position through this period. However, in the last week or so, we have started to deploy some of this cash back into the market for the reasons which I'll share with you later. So moving along, I'll run through the slides and I'll quote the numbers. The slides will be posted in front of all of you so you all can follow. As you can see on slide 2, it's the agenda that we're going to run through for today. And you can just skip ahead to slide number 3. Just by way of snapshot and by background, you can see here, this is data up till the 24th of March. You can see here the sell-off in the markets have been quite sharp. The speed at which the market sold off this period has been exceptional, even for someone like myself who has seen many crises in the past 20 or so years. Just to quote a few examples here, you can see the blue bar chart, EM, which represents emerging markets. We saw as at 24th of March, we've seen emerging markets sell off to the tune of close to 30%. And on the extreme right, you can see that crude oil had been sold off to the tune of 60%. And since the 24th of March, we've seen a lot of these markets and currencies actually rebound a little bit. I think from the bottom, some of the markets have rebounded by between 10 to 15%. Case in point being the US market, as well as some of the Asian markets. The only exception continues to be oil, but oil has got other issues that they have to contend with. Number one, because of the sudden shutdowns in economies all around the world, demand for oil has obviously fallen off the cliff. Just to give you some sense, if you take into account US demand, European Union demand, and Indian demand for oil, these three regions already make up 40% of global oil demand. And given that a lot of these countries are in shutdown mode, you can then expect that oil demand will continue to remain low until there's a normalization of economic activities. In addition to that, on the supply side, Russia and Saudi are currently at loggerheads. They can't seem to agree to cut down oil production. And in fact, both parties have come out to say they want to boost oil supply. And the combination of these two factors, increased supply and reduced demand, would definitely lead to oil prices staying low. However, there is a possibility that both Saudi as well as Russia may come back to the negotiating table to try to come to some sort of an agreement to reduce oil supply. Apart from that, emerging market currencies had sold off as well. Although in the past week, there's been a little bit of a recovery because we have seen that the US dollar has weakened a little bit in the past week as a result of some of the actions that have been undertaken by the US Federal Reserve to boost the availability of US dollars around the world. So that's a little bit of background about how markets have performed. Suffice to say that the sell-off has been very sharp and very quick. Now, moving on to slide number 4. The way we're trying to navigate through the current environment is by relying on a fairly simplistic framework. Internally, we call it the 3 Ps. The first P stands for policies. The second P stands for profits. And the third P stands for positioning. If I can take you to the first P on the next slide. When we talk about policies, we are referring to both fiscal policies, which means government spending, as well as monetary policies, which are the policies announced and implemented by central banks around the world. And as the header on this slide suggests, policymakers around the world have definitely unleashed their bazookas. There is a saying in investments that when policymakers panic, markets stop panicking. And this is in fact what we have seen in this round. We have seen central banks initially come to the rescue by cutting interest rates. We've seen the US Federal Reserve cut interest rates. We have seen central banks in other parts of the world as well cut interest rates, including closer to home, countries like India, countries like Indonesia, and in Malaysia as well. Central banks have cut interest rates. In addition to that, the Federal Reserve has gone beyond that, given that the US Federal Reserve is ultimately the central banker to the world, and knowing that there was a liquidity crunch or there was a shortage in US dollar, the Federal Reserve has, in the last week, actually announced measures to provide more US dollar liquidity to the rest of the world. So you can see on the left side, the chart shows you global monetary policy rates. They have been slashed extensively. Example given is of the US Federal Reserve, where year to date, in the past month, they've actually cut interest rates by 1.5%. So at the start of the year, the US Federal Reserve overnight rate was at 1.5%. As of today, it is 0%. The whole idea of cutting interest rates is to cheapen the cost of liquidity and to try to support the underlying economy. In addition to that, you can see the graph on the right-hand side. As far as fiscal policy is concerned, or budgetary policy is concerned, we can see that central governments around the world have also embarked on very large fiscal stimulus measures. As of now, the G4, which is the US, EU, and Japan, and including China, they have announced stimulus packages totaling 4.3 trillion US dollars to try to prevent the underlying economy from deteriorating further. This is after taking into account the $2 trillion package that the US government has announced and which is awaiting President Trump's signature for them to start implementing. In fact, this afternoon, there was news as well that the US was looking at implementing an additional stimulus to the tune of 400 to 600 billion US dollars to help to address the underlying economy. So the point I'm trying to make here is that policymakers have started to panic. They're doing all they can currently to prevent the economy from deteriorating further. The example I'd like to use is to view the global economy as that of a very sick patient. What the policymakers are trying to do is trying to prevent a patient from going into ICU or intensive care unit. They're trying to stop the bleeding in the global economy because of the shutdown and the lockdowns. Economic activity will definitely deteriorate very sharply. People cannot go to work. Businesses cannot operate. Manufacturers and service providers are also not able to produce goods and services. So the impact on the demand side and on the real economy is very, very severe. So what the policymakers are trying to do is to ensure that businesses can continue to remain not in operation, but to ensure that they can survive this period, be it 3 months or 6 months, such that when COVID-19 passes, this pandemic passes, these companies can start operating again and continue to employ the people that they are currently employing, as opposed to them sacking all their employees, and these employees will suffer. And when the time comes to restart businesses, they are not able to start business because they are not able to address their employment requirements. If I can just refer you then to the next couple of slides. These are just details of the policy measures that the central banks have done. On slide 6, these are the policies that have been announced or implemented by the US Federal Reserve already. Now, I would just like to bring your attention to the final paragraph of this chart, March 23rd, which is when the Fed announced what we think was the ultimate policy which helped address the dislocation that we saw in financial markets. If you bring your mind back to about 2-3 weeks ago, what we saw was severe dislocation of the financial markets, and that included even previously very liquid asset classes such as US Treasuries, where we saw very wide bid-ask spreads, and we saw very gappy price movements in even the US Treasury yields. In addition to that, we clearly saw that even the investment grade markets, there was hardly any liquidity. There were no bids. If investors wanted to sell their positions, there was no one on the other side to buy these securities. And even worse was the high yield market, where there was completely no market at all. So the measures that were announced by the Federal Reserve on the 23rd of March, you can read them for yourself, but they have significantly helped to address this dysfunctional environment, this dislocation that we saw in the bond markets. And in the past week or so, we are encouraged to see that the financial markets, as far as the credit markets is concerned, in the investment grade space and in the US Treasury markets, we have started to see these markets function more normally, which is a positive sign. Because ultimately, US Treasuries and the credit markets is what determines how the rest of the financial asset classes perform. So the policy measures that have been announced by the US is welcome. It has helped to address this dislocation that we saw. In fact, in the past week or so, we are also encouraged to see that there have been companies coming out to issue bonds in the investment grade space, and the demand for these bonds have been strong. And a lot of these primary issuances that we've seen in the past week have actually gone on to trade at higher prices. So that's a positive. The next slide, on slide number 7, it's similar actions that have been undertaken by other central banks in Europe, in Japan, as well as in the UK. And that's for your own information. I will not run through those. Moving on to the next slide, which is slide number 8. On the fiscal policy side, these are the details of the key fiscal measures that have been announced by governments around the world. The US, with the $2 trillion package, what the quantum of this fiscal stimulus amounts to about 10% of US GDP. So by all accounts, it is a very large stimulus package. Other countries as well have done their level best to try to stimulate the economy, to try to prevent the economy from deteriorating further. The UK, for example, has also announced similar type measures to support the labor market, to continue to pay up to 80%, I believe, of the wages of salary earners and wage earners, so that they can continue to survive through this period. And they've also provided stimulus measures to ensure that companies can continue to remain alive through this period, such that when COVID-19 passes, these companies then can restart operations and maintain their workforce. That's on page 8. And as I said earlier, how we're trying to navigate through this is through the 3 Ps. So on the first P of policies, if I were to give it a grade, I would give it a tick, because the policymakers around the world are doing what they can within their authorities and within their limits to try to ensure that the economy does not suffer too much more from the lockdowns that we are seeing all across the globe. So on policies, I'll give it a tick, a passing mark. Now, if we can move on to the next P. The next P, which is on slide 9. Slide 9 refers to profits. For us as investors, as fund managers, when we invest into the market, ultimately we are looking to invest in companies whose profits can grow. However, from what you can see here, leading up to 2020, towards the end of 2019 and at the beginning of 2020, we have been seeing positive earnings upgrades for Asia ex-Japan companies. But since the onset of COVID-19, beginning in China and subsequently spreading to the rest of the world, we have seen earnings forecasts being downgraded. And to us, this is not a surprise. And in our estimates, clearly there's further downside as far as earnings revisions is concerned. We expect analysts to more significantly cut their earnings forecast for 2020. And the issue now is the lack of visibility. For us as fund managers and investors, there is no visibility. When we engage with the companies as well, they themselves have no visibility. In fact, there have been a lot of companies that have come out to withdraw their guidance, earnings guidance for 2020. And many of them have also opted not to provide any earnings guidance for 2020, simply for the reason that they themselves do not know the extent of the impact to their revenues and profits, so long as this COVID-19 and lockdowns are in place. Right? But I just want to remind everybody on this call that while earnings estimates or earnings forecast is one part of the equation, you have to always remember that stock markets also look forward. And given the sharp sell-off we've seen in stock markets, I would argue that part of this revisions downwards in earnings that we will see has been priced in by the stock market. However, if I were to give a grade to this second factor of profits, I can't give it a tick. I would have to give it a 0 at this point in time, because as I said, there is presently hardly any visibility. It's anybody's guess what the earnings outlook is going to look like. So for us, one way to look at this is to just write off 2020 earnings. And when we look at the ideas that we want to invest into, we will just look beyond 2020 and see what these companies can do in terms of their earnings and profits into 2021. And that is the approach we're adopting. And I believe that is the right approach for you as investors as well, to perhaps assume that 2020 is a write-off and to have an investment horizon beyond just 2020, but to look out the next 1, 2, 3 years. Because if you're prepared to have time in the market, and if you have monies now, I think it is time to start deploying monies back into the market, taking that 2, 3 year view when we expect that things would normalize by 2021, 2022. So just a recap, policies gets a 1, it's a tick, profits, it's a 0, but reminding you again that stock markets have also priced in a significant element of these earnings downgrades that we are seeing and that we will continue to see. Now, if we can move on to the next slide, which is slide 10, the third factor that we're using to help us handicap how to navigate the current investment environment is what we call positioning. Now, positioning is essentially a measure of sentiment. And for us as fund managers, these are some of the tools that we rely on in order to help us navigate, especially turning points in the market. If you can just look at this slide here, the green and red chart on the left, you can see that sentiment is already at very bearish levels. In fact, it is currently at 0, which shows that the broader investor base are currently extremely bearish about financial markets. To us at Affin Hwang Asset Management, when we see that the broader investor base is extremely bearish, it's time for us to be a little bit contrarian and to start looking for ideas as to where we want to deploy monies back into the market. Of course, at 0, it cannot go any lower, but I just want to caution you as well that during the global financial crisis, this indicator went to 0 and stayed at 0 for about approximately 6 months. So while it is currently extremely bearish, it can stay bearish for a while more if things were to continue to deteriorate and there's no light at the end of the tunnel insofar as COVID-19 is concerned. On this point as well, while I've been sharing with all of you on this call that we have been deploying monies back into the market, you have to remember that we are starting from a fairly comfortable position in terms of our cash levels. Before the start of this accelerated sell-off, our fixed income funds were sitting on about 20-25% cash levels. Our equity funds were sitting on between 30 to 50% cash levels. And experience has shown us that it is impossible to time the bottom. So what we're trying to do now is nibble back into the market, but always at the back of our minds, telling ourselves that we are prepared for the markets to move lower. And as they move lower, we will continue to deploy some of the cash we have back into the market. So in short, we are prepared to average down if the need arises. Now, if I can just take you to the next slide as well. The next slide, again, it's a guideline or framework that we look at in order to try to gauge how much more selling there could be in the market. Obviously, no two crises are ever the same, but it is just a framework we use to try to get a guesstimate of how much more potential selling there could be. So let me refer you to the first line, 12th February 2020 to 18th March 2020. During this period, we saw 5 consecutive weeks of outflows from emerging market funds. These are fund flows by foreign investors. And during this 5-week period, we saw total outflows of $24 billion, which equates to approximately 3% of assets under management of these emerging market funds. And during this 5-week period, we also saw a very sharp sell-off, as shown by the MSCI Emerging Markets Index, which declined by close to 30%. Clearly, since that date, we've seen some rebound in financial markets. But the point I'm trying to make is we had seen a very sharp sell-off. We have seen huge outflows from emerging market funds. So the billion-dollar question that we ask ourselves, and I'm sure it's a question that most of you would have on your minds, is this all, or is there more to come? The answer is we don't know. Right? Just to give you some examples, if you look at the middle part of the table, during 2015, from 3rd June 2015 to 16 September 2015, this was the period when China got into some trouble and China proceeded to devalue the renminbi. During that 15-week period, we saw $46 billion worth of outflows from emerging markets, which equated to 6.6% of asset management. But during that period, you saw that the emerging markets index only dropped by 17%. Now contrast this with the last line, where during the global financial crisis, 1st October to 29 October, of course, over that global financial crisis period, we saw many weeks of outflows. But in this particular case, there was 4 consecutive weeks of outflows, totaling only about $7 billion US. But that resulted in a decline in the MSCI Emerging Markets Index of 35%. So the point I'm trying to highlight here is, as I said, no two crises are the same. It just gives us an approximate sense of how much markets have come off by, how much selling has been done by foreign investors, and for us to arrive at some form of a conclusion to help determine whether it's time to go back into the market. And based on this table, judging by how much markets have declined by and the amount of outflows that we've seen, it is our view that it is time to get, we are ready and we have started to nibble back into the market because we think the selling has been quite extensive. It may not be the end of it. There could be a further dip in markets. We're not sure. We're not sure whether this is the bottom or this is a bottom. We've seen in prior crises, an example being the global financial crisis, where after the initial sell-off, we saw a series of bear market rallies where markets rebounded very sharply, only to then come off again. This time around, we're not sure whether that would repeat, but if it does, we have the cash available to deploy back into the market as well. So that is the third P, and that's the third P is positioning. So again, back to handicapping these 3 Ps. On the first P of policies, we gave it a tick. On the second P of profits, no tick, but remind you again that financial markets, stock markets have partially priced in this earnings deterioration that we're seeing. And on the third P of positioning, I would give it 3/4 of a tick, because looking at flows and how much markets have sold off, we think it is appropriate to give it 3/4 of a tick. And what that means to us is we are then currently looking to deploy money back into the market. So out of the 3 Ps, we get 1 3/4 out of 3, and that is reflected in our current asset allocation of about 70 to 75% invested for generally across our equity funds. So that's on the 3 Ps. Of course, all these 3 Ps would be less relevant if we can answer the third, the next point. Moving on to slide number 12. If any of us here can forecast accurately when peak infection rates would come or would end for countries across the world, as far as COVID-19 is concerned, then we can with more certainty determine how much more we want to invest back into the market. You can see on slide number 12, China obviously was the first country that got into COVID-19, but China is now on the recovery path. Korea has only in the past week moved ahead and beyond the peak infection rate, and they're now clearly on the path of recovery. The other countries that are of importance to us as far as the investment market is concerned is clearly Europe, Italy, Spain, Germany, France. Italy, in the last 3 or 4 days, there have been encouraging signs where we have seen the daily new cases in Italy start to come down. So Italy is crucial because a lot of people view Italy and Spain as the template for what's going to happen in the UK and US. And Italy, given that they subsequently, although not initially, they imposed strict quarantine and containment measures, they managed to flatten the curve and they are now on the path to recovery. I think Italy, give it a week or so, they will then move down the curve to recovery. Obviously, the biggest elephant in the room is the US. And the US, as you can see here, based on this schematic chart, this model, which we obtained from some of the specialists, experts out there, the US is still in the late accumulations phase. And based on estimates by the experts, for the US to hit peak infection rate, it looks like it will take another 6 to 8 weeks. So within the next 6 to 8 weeks, if there's no further mutation of the virus and the US continues on this predicted curve, we think then we would have a clearer sense of how markets would perform. We have seen that in the case of China, Korea, we have seen in the past during the SARS crisis, when infection rates peak, the markets start the bottoming process very quickly thereafter. In the case of the US, I think that the markets could even look beyond the peak, given the experience that the markets have seen with other countries. And so long as people can, with more certainty, predict when peak infection in the US is going to be, I think the markets would start looking beyond that, rather than waiting for actual data to confirm the peak. Now on the US as well, on slide 13, the chart on the left shows you the predicted outbreak dynamics in the US. The next slide, please. You have the bear, base, and bull case scenario. Currently, the US is on the blue line. It is moving along the base case scenario path. So long as it continues on this path, and so long as the US accelerates the number of tests which they do daily, we think that it will be something that they can resolve. And if they enforce their lockdown and containment measures, which they've now announced they will extend to end of April, then we think this can be brought under control, which will be a positive for financial markets and the global economy generally. On slide 14, you can see that China has already brought things under control. In fact, since the 18th of March, all the new COVID cases that we've seen in China have come from what we call imported cases. So these are Chinese nationals or foreigners traveling back into China from overseas, and they are the ones that have been infected, and has resulted in China also imposing quarantine measures and travel restrictions on foreigners coming into China. Now on China, given that China was the first economy to suffer from the pandemic, and given that it's the first economy that has recovered from the pandemic, if I can refer you to slide 15, this is a map which shows the activity levels of industries across the various provinces in China. So in general, on average, China industrial activity is now back to 85% of normal levels. Even in the epicenter of COVID-19, Hubei, it is now back to 50% of normal activity levels. Consumption activity as well, with the exception of auto and travel, is back at 85% of normal levels. Now, why is this relevant to us? As I said earlier, we entered into this period with ample amounts of cash, and we've been looking for ideas to deploy the cash into. So one of the countries that we have started deploying monies into is into the Chinese market, or the Hong Kong market, of companies, Chinese companies listed in Hong Kong. Companies that would benefit from this recovery in domestic consumption activities or normalization of behavior in the Chinese economy. That's where we've spent a lot of time focusing and looking for ideas. So as far as COVID-19 is concerned, I think it's something that we'll have to live with in the near term, in the next 4 to 6 to perhaps 8 weeks. Touch wood, there's no further mutation of the virus, but if there is none, then in the case of the US, 6 weeks away, then perhaps we'll see peak infection rates taper off in the US. Now, moving on to slide 16, we have also been spending time looking at beyond the nearer term, what are the potential solutions to COVID-19 to ensure it doesn't occur again. Now, clearly, the first one would be if a vaccine can be found and available for mass consumption in the near term. However, based on our understanding and our research, the development of a vaccine takes time. In a normal environment, even if they were to fast track the regulatory approval, it will take between 12 to 18 months for a vaccine to be approved and to be certified safe to be administered to the general public. Overnight, a US company called Johnson & Johnson, they announced that they are accelerating the development of their version of the vaccine. They have announced that they will embark on human trials in September, and if everything goes to plan and is successful, they think they could get a vaccine out by January or February in 2021. So that remains to be seen, but it is a development that we are monitoring closely. But having said that, the development and the availability of the vaccine does not solve the current situation. For that, we have also been devoting our research and time to looking at some other alternatives. Moving on to slide 17. Where there is perhaps shorter term, more nearer term potential is in what we call repurposed drugs. What do these repurposed drugs mean? Repurposed drugs are essentially drugs that are currently available but currently used to treat other ailments. So there are two which have shown some degree of efficacy in treating COVID patients. And these two are called, the first one is called hydroxychloroquine, and the second one is called remdesivir. Both these drugs, there have been trials done. Currently, there are 9 clinical trials for HCQ, and I think for remdesivir, there are currently 5 clinical trials being conducted. The issue with these trials at the moment is that the sample size for these trials are still small. I think the researchers and the scientists need to spend a little bit more time to ensure that there's a broad enough sample size. That's one. And two, to ensure that there are no side effects which are detrimental or fatal to some of these COVID patients. But so far, based on the small sample size and the clinical trials that they have conducted, it has shown to be effective if administered in the initial stages of COVID infection, if a patient is diagnosed early, and the patient does not have any other ancillary ailments, such as heart disease or other forms of illnesses, which would then negate the effectiveness of these drugs. That is the results that we are reading at this point in time. And if it's proven to be successful, then we can expect that the FDA, that equivalent of the FDAs around the world would approve these drugs to be administered for COVID patients. In fact, over the weekend, the US FDA has already approved HCQ. I think this was at the insistence of President Trump, and the FDA has actually approved HCQ. However, we're not certain whether the medical practitioners would administer it widely, given that the tests are not conclusive yet. The clinical trials have not proven conclusive. However, the authorities are doing all they can to accelerate the approval of these drugs if they are proven to be effective. I'll skip the next couple of the next slide, and I'll just take you on to slide number 19. Slide number 19 is on the fixed income market. The line spiking up shows the spreads of investment grade bonds in Asia, as well as high yield bonds in Asia, as well as in the US. So what we saw in the initial stages of this sell-off was that the bond markets or the credit markets, as I said earlier, was dislocated. We saw bonds sell off very, very sharply because investors wanted to sell. And on the other side of the coin, there were no buyers. Because since the global financial crisis, the banks, given regulations, are no longer able to market make as extensively as they did in the past. And a lot of investors were rushing out through the same exit. So we saw bond prices correct very sharply. And in the cases of most of the investment grade bonds, the high quality bonds, they were all sold off indiscriminately. The deterioration in their bond prices had nothing to do with the fundamentals of the company. And we viewed this as a good opportunity for us to nibble back into the market because we felt that the selling was unjustified. If you recall, in one of my earlier slides, when the Federal Reserve came out on the 23rd of March to announce the liquidity measures to address this dislocation in the fixed income markets, we started to see things normalize, and bond yield spreads have actually come off. And in fact, we have seen increased new bond issuances in the past week. So all these are positive signs. It shows that things are beginning to normalize. And as I mentioned earlier, and at the expense of repeating myself, a functioning US bond market, US Treasury market, functioning investment grade market, functioning credit market is a necessary requirement for the broader financial markets to function normally. And we have seen that follow through into equity markets as well, where there is now still high volatility, but less extreme volatility that we saw in the last 3 weeks. On fund flows in the fixed income market, if I can take you to the next slide, slide 20. Similar to what we saw earlier for equities, clearly there was also redemption pressures and selling pressure in the fixed income space because investors were jittery and unnerved. And given that there was also a shortage of US dollars, investors were all rushing to exit their investments, to unwind their investments in order to obtain US dollar cash. Again, the US Federal Reserve in their policy measures had announced that they would provide swap lines to afford US dollar liquidity to various central banks around the world. And that has helped to mitigate this rush for the exits that we saw initially during this sell-off. On slide 21, repeat of what I addressed earlier, but this gives you a sense of the extent of interest rate cuts implemented by various central banks around the world. This is just for your information. And in terms of what we're monitoring, slide 22, clearly the key thing we want to watch out for is COVID. If current estimates of COVID peaking in 6 to 8 weeks proves to be true, then I think the markets can recover very sharply. However, during this next 6 to 8 weeks as well, we will be keeping our eyes and ears close to the ground to see whether there are any dead bodies that surface as a result of this dislocation that we had seen in financial markets and the shutdown in economies all around the world. Because while it's initially a health issue, it has led to a financial crisis. We want to see whether it has secondary impact to the real economy in terms of whether a financial player goes under, a large hedge fund potentially, or a large company goes under, which will then trigger other ripple effects to the broader supply chain and the broader economy. So that's what we're monitoring over the next 6 to 8 weeks, aside from COVID infection rates. Second thing we are monitoring very closely is how markets respond to the policies that have been announced. So far, from what we've seen, the markets are responding positively to both fiscal and monetary measures that have been announced. And while this does not address the demand side of the global economy, this at least prevents a patient from going into ICU. Third point we're looking at is clearly portfolio flows. Earlier, I shared with you about how we're trying to rely on prior crisis to see the extent of portfolio flows, whether there's any further outflows. But specifically for the fixed income side, while we had witnessed very sharp outflows from both investment grade and high yield bond funds, we are encouraged to see that in the last week or so, we have actually seen some inflows into high yield exchange traded funds and fairly significant inflows back into investment grade ETFs. So to us, it shows that there are buyers out there who find that values are attractive enough for them to put monies back into the market. I will skip number 4 and point number 5, credit risk. Clearly, given the extent of the economic shutdown, there will be certain companies whose businesses would suffer significantly. And for us, as fund managers of bond funds, we are constantly monitoring the health of the papers or the credits in our portfolio to ensure that the companies that we continue to own would be able to survive this crisis. Clearly, some sectors of the economy, for example, some of the high yield bond issuers in the oil and gas space, they would struggle to repay their debt. However, we do not own any of these names. So in conclusion, as far as our investment strategy is concerned, just to remind you about the 3 Ps, policies, profits, and positioning. We give policies a tick, we give profits no tick, and we give positioning 3/4 of a tick. Again, repeating myself, while profits, there's no visibility as to profits, markets have also corrected significantly. And if we are prepared to look beyond 2020 and believe that there's a normalization in 2021, I think a lot of stocks today at current prices, and if you assume 2021 things normalize, there are a lot of attractive opportunities out there, provided this crisis does not deteriorate further. Slide 23 is a summary of our investment strategy. Our portfolios are defensively positioned. From being about 40% in cash, we have now brought it down to 25% approximately. Fixed income is still about 15 to 20% in cash. So we do have the ammunition. Our experience has shown us that during times like this, it is most important to come up alive. We cannot pick the bottom, we cannot time the bottom. And as I shared with you earlier, we have seen in prior crises where there was a sharp sell-off and then a quick, sharp rebound, succession of these episodes happening before the markets finally bottom. This time around, I'm not certain it will repeat what we saw in the global financial crisis, because this episode could just last for another 6 to 8 weeks before things normalize. So perhaps if there is no dead body that appears, perhaps we can see that the markets go through this bottoming process in a much quicker time frame. At this juncture, for us managing our funds, there is the potential to make 2 errors, type 1 error and type 2 error. For the type 1 error, it's putting monies back to work too quickly, or putting back all the cash that we currently have back into the market, taking that risk and trying to be a hero. It could prove to be the right decision, but we can only tell in hindsight. If we were to be 100% invested today and markets have already bottomed and continues to only move higher from here, of course, we would look good by the end of the year. But I think as responsible fund managers, we would rather opt to commit. If we were to commit an error, we would rather commit type 2 error, which is to be on the cautious side. So for us, while we have been nibbling into the market, we are not prepared to go all in at this point in time, given the volatility that we'll continue to see, and given that there's still a high level of uncertainty insofar as how this pandemic would evolve, whether it would then lead to broader crisis in the financial system. So the next 6 to 8 weeks is key to watch for us. If, as and when we spot opportunities at the right valuations, we are prepared to invest in those opportunities, both on the fixed income side as well as on the equity side. So in conclusion, the 3 Ps, remember that's what's guiding us at this point in time. Second piece of advice I'd like to share is for those of you who are prepared to put some money back to work into the market, I think it is okay to do so, but be prepared that markets may still continue to go down post this rebound that we're seeing. And if the markets do go down, set yourself various levels at which you are then prepared to average down into the market. I think that would be the most prudent form of advice that we can share with you, rather than putting everything you have into the market now. To stagger it would be a more responsible approach to take. So with that, I end my presentation and
Unmuted.
open up the floor to questions.
Thank you, Mr. David Ng. Ladies and gentlemen, we will now resume back the chat session. So if you have any question for Mr. David, feel free to actually type it in the chat session and we will proceed to answer your question. Okay, we have the first question. What is the outlook of technology stocks?
Okay. For technology stocks, I think we can divide technology stocks into two sub-segments. One is the hardware sector, and the other one is the software or communication services sector. So in the hardware sector, it was a sector that we were positive on. In the hardware space, you would have the DRAM makers, the foundry players such as TSMC, DRAM makers such as Hynix, and Samsung and Micron in the US. While we had initially taken some money off the table for some of these names, we have in the past week or so started putting back some money into these companies, because what we have seen, even though we are in this crisis for the moment, we have seen that the demand for DRAM remains very strong, largely driven by the server space. With so many companies now having their employees work from home, people conducting meetings remotely, the server space is the one where the demand is very strong. The cloud segment industry is also seeing very strong growth and increased utilization. So this is what's driving the demand for DRAM. On the other side of the coin, mobile phones as well are consumers of DRAM. And while we expect that mobile phone sales would decline this year, from what we gather, the demand from the server space is sufficient to offset the decline from the mobile phone space. So that's on the fundamental aspect of hardware. The other thing we always look at when we look at companies is also the valuations. And some of these stocks, when you look at the valuations compared to where they have traded in the past, they do represent attractive values to us. Some of the names I mentioned, like Hynix, Samsung, they're trading at just slightly above their book values. So for us, we think it is appropriate to nibble back into some of these names. So that's on the hardware space. We continue to remain positive on the 5G sector. Although it has been delayed, we don't think it's been derailed. If it doesn't happen in the next 3 to 6 months, as we enter into 2021 and beyond, I think this 5G theme would continue to grow. And this would be a sector that would drive the demand for some of these hardware products made by the companies that I've just mentioned. There are also other companies that we like in Taiwan especially, which are exposed to the 5G theme, which are exposed to server and the cloud industry. So that's on the hardware side. On the software side, we do like quite a few companies in that space. We think that some of these names represent very good long-term investments because, number one, they have what we call a moat. They operate in either almost a monopoly-like situation or at most duopoly or oligopoly. These companies have got very strong brand name, very wide customer base, and a lot of these software companies have in the past 3 to 5 years migrated from being to being a subscription-based model. So what's good about having a subscription-based model is that they get recurrent revenues and they get consistent cash flows. Some of these companies, example I'll give is Microsoft. Cash flows remain strong, strong brand name, and they are also very profitable. If you look at their returns on equity, you look at their profit margins, they are very, very high. And it's way above what we see in traditional industries. Now, of course, in the current environment, these stocks have also been sold off. But as I said earlier, if you're prepared to look beyond 2020 and look beyond into 2021 and further, some of these names already represent good value. And aside from some of these software names, of course, you have got the common names in the what we call the communication services names. In Asia, names like Alibaba, Tencent, some of the other disruptors in the US like Amazon, Facebook. I think these are companies that have also been sold down sufficiently for them to represent good value. And for us, we view these companies as long-term investments. While we may trade around our positions to take profit or to preserve capital, these companies would typically represent the core positions in our portfolios, because we believe that irrespective of the global macroeconomic environment, economic growth may slow down or may grow faster. These are companies that independently are able to deliver earnings growth into the next 5-10 years. So in short, we like both the software and some of the hardware companies in the tech sector.
Okay, thank you, Mr. David. Moving on to the next question. The economic bullish cycle has been running for more than 10 years, and recent short corrections, wouldn't it be too short, and are there more room to bottom?
Yeah, you're right to say that the economic cycle has been going on for, I believe, 130 months or so. It is extended. However, not all cycles are the same. We've seen some cycles only last for 2 years. This obviously is the longest that we've seen, because different era, we have different experiences from navigating through crisis and navigating through recessions that we have learned, or the policymakers have learned from the past. Clearly, the policymakers today have learned from their experience during the global financial crisis. And while personally, or some of us may agree or disagree with the measures that they've undertaken, cutting interest rates to zero, or spending so much of the government budget and resulting in such large budget deficits for the various countries, the environment now is perhaps different from what we've seen traditionally in the past 20, 30 years. And for us, I always say we have to manage money in the current environment. And in the current environment, it appears that investors are still prepared to give the benefit of the doubt to policymakers that they will be able to help navigate, that they will be able to navigate through the current crisis that we're facing by cutting interest rates, by pumping liquidity into the market, and by, in the recent weeks, embarking on large fiscal stimulus. So we have to manage your portfolios based on the current situation and what we think how other investors would react. So that's to address the first part of your question. Could you just repeat the second part of the question?
The second part is, are there more room to bottom?
Okay, the second part of the question, I think I touched on it earlier in my presentation. Whether what we saw last week was the bottom or a bottom, I don't know. I don't think anybody out there can say with high level of certainty that the markets have bottomed and it's only going to move higher from here. I shared with you our experience during the global financial crisis. It went through a bottoming process, right? It took 17 months. Market sold off, then rebounded, then sold off again and rebounded. Subsequently, it was only in March 2009 that the markets put in the final bottom. I think this time around, it will not be as protracted as what we saw during the global financial crisis, but I can't say with certainty. If I could, I don't have a crystal ball, so I can't say with certainty that the markets have put in the ultimate bottom, which is why my advice to investors out there is, look, I think it is an opportune time to put some money back to work, but I will not encourage you to if you have $100, don't put in $100 now. Perhaps spread it out into 3 or 4 tranches. And should the market, if we are wrong and markets continue to move lower, you still have ammunition to go back into the market. So don't put all your monies back into the market at once. On our side, we'll try to time it as best as we can. As I said earlier, there are two potential errors an investor can make currently. Number one is invest all that we have now. Turn out to be right, then you look like a hero. But if we are wrong, the pain would be severe. And my philosophy in the current environment, my philosophy has always been to make sure we come out of this alive, to ensure that we have liquidity and that we have cash. Even if we miss the bottom, it is okay, because capital loss is something you cannot recover. Whereas if you have cash and the markets continue to move higher until I'm prepared to deploy more money to work, at least I'm not losing money. I can try to catch up later on. So my philosophy is I want to be a little bit more cautious. We have been putting money to work, but I'm not prepared at this point to put all the cash that we have in the funds to work.
Okay, thanks, Mr. David. Okay, we have a lot of questions in the chat session for Mr. David. So we will try to, keep the answer short and try to answer everyone. Okay, so we'll move on to the next question quickly. Would your views be the same for global sukuk?
I'm not an expert on global sukuk, but just generally for fixed income, I think given the sell-off that we've seen in bonds, not just high yield, but also investment grade, I would, speaking on behalf of my colleague, I would think that there are opportunities already in general in the fixed income space. Specifically for global sukuk, perhaps we can answer this offline. And the reason why I'm saying that is because I need to look further to see what the universe of the global sukuk space is. I know Malaysia would have a lot of sukuk issuances, but outside of Malaysia, the other big region which issues a lot of sukuk would be the Middle East region. And given where oil prices are, some of these issuers could be under a little bit of pressure, unless, of course, we are investing into the high quality ones which are backed by very strong governments. So broadly speaking, for fixed income, I think there are opportunities already. For sukuk, it really depends on the specific issuers.
Okay, thanks. What about your views on healthcare sector?
Okay, we do have a healthcare fund, but as some of you may know, it is not a fund managed by us. I think currently the healthcare sector is the in thing. It is what investors like because they associate healthcare with, companies are able to resolve pandemics and COVID and whatnot. I think the healthcare sector, even regardless of COVID-19, is a sector that has got multi-year growth. And I say that just simply based on demographics. As global demographics age, people would tend to spend more on healthcare. And if you're invested in the right companies with the right products or right services, then I think the healthcare sector is a sector to consider as part of your portfolio of investments.
Okay, Ken, what is your outlook on Malaysia politics? Will politically linked companies like MyEG go out of favor for the long term?
Okay, first and foremost, I refrain from giving any stock-specific recommendations or advice. So if you're asking me about MyEG, I have no comments to that. As far as Malaysian politics is concerned, I think there are a lot of us out here who have our own views on Malaysian politics. Some argue it's a backdoor government and whatnot. I think for us, similar to how we invest monies all around the world, we have to invest in the current environment. And I think in the current environment, the Malaysian market, while there are absolute gems out there, and we are also starting to invest back into some Malaysian companies, from a relative standpoint, we prefer markets outside of Malaysia. As far as Malaysian politics is concerned, it remains to be seen. We'll have to wait until May when Parliament reconvenes to see whether the numbers are there, whether there are any switching involved before we know how things will eventually work out. However, I just want to say this, that given the political environment, whichever way it turns out, until there's more clearer certainty as to the formation of the government, I think Malaysia, in terms of the attractiveness of Malaysia as an investment destination, would rank low compared to some of the other countries. So domestic consumer confidence, businessmen, investor confidence as well, uh, would be low at this point in time because there's no visibility as to the political stability of the country at this moment.
Okay, Ken, what's your point of view on gold and silver?
I don't really look at silver. The only comment I can make about silver is that there are, so-called people who follow the gold and silver market, and they are arguing that silver should play catch up to gold because while gold prices have, generally rallied, silver has not caught up. So the gold to silver ratio is very high. So they believe that silver should re-rate. That's the only comment I have on silver. As for gold, yes, I believe for those of you who believe in the properties of gold and gold as a store of value, gold should be a part, maybe not large, but some part of your portfolio because gold has proven its qualities during periods of crisis. So if we were to go to a hyperinflationary crisis because of all these stimulus measures that have been implemented, then gold is a good hedge against inflation. Similarly, when we look at the performance of gold during deflationary situations or when there's a crisis type situation, gold is also a good store of value. So yes, I think gold can be a part of your portfolio of investments.
Okay, so what will be the top three sectors that will not be so much impacted by the impending recession?
Okay, there are quite a few sectors. I mean, clearly, it really depends on your risk profile as well, right? Clearly, companies which have got concessions or utilities, such as telcos or electricity companies, these are companies whose businesses would be almost operating as per normal. I mean, clearly, electricity companies, their demand side would be lower, but if you're operating a concession, then it would be almost business as usual. But in terms of where we think the opportunities are, and I alluded to this earlier in answering one of the earlier questions, we think some of the tech and software companies, the communication services companies, they would do well even if the economy was struggling or economic growth was to slow down. Example, I'm not asking you to go and buy Tencent with gaming, with the potential to monetize the other features that they have in terms of e-wallets or transfer of payments. I think these are all multi-year growth stories. So you don't have to be too concerned with, what's GDP growth like in the next 3 months, in the next 6 months. And these are the sorts of companies that we like. The other example I quoted was Microsoft. While business may slow down a little bit in the next 3 to 6 months, but beyond that, these are multi-year growth businesses.
Okay, which sectors in Bursa would you consider today after the recent run-up?
There are a few. Again, we talked about the tech sector earlier. I think as far as Malaysia is concerned, what we're looking at is companies that are not affected too much by politics in Malaysia. So one sector that is not affected by politics in Malaysia, but it's rather driven by the global economic environment would be the so-called tech sector in Malaysia. Those that are exposed to Apple new products or 5G theme. I think some of these stocks have also sold off and it's worth looking into. There are some other stocks, but these are individual stock picks that have been sold off indiscriminately when the broader market sold off. I can't give you any specific names, but there are some ideas out there which we think represent good value. Some of these could be in the manufacturing space because currently there's a lot of concerns, as you and I appreciate, about economic lockdowns, about workers not being able to go back to work. So a lot of these factories are not able to operate at 100% capacity. They can at best operate at 50% capacity. But if you are like me and you can identify companies that can survive this difficult period, and if you believe the global economy and the demand for such products would recover, whether it's in 6 months' time or 12 months' time, then some of these companies are trading at very attractive valuations if we are looking at 2021 earnings and assuming normalization.
Okay, what are the attractive rates post-COVID-19 crisis?
Again, I do not give specific names. It is something we do not do. I think yourselves as investors or even as laypersons, you should have a sense of which segments. It depends. If you think that things are going to normalize, things are going to recover, consumer activity is going to go back to normal at some point in time, and even if some of these landlords have to cut rentals for this year, then you just write off this year and look into next year. And you yourself in your daily behavior and daily activity, I think you can identify some of these REITs which you think can survive and can do well as things normalize.
How much of our cash should be deployed to the market now in terms of percentage? And how long is the investment horizon we should take to gradually deploy our cash back to the market?
This is a very tough question to answer because each individual has, you would have your own unique circumstances. But just broadly speaking, I would say tranche it out 3 to 4 tranches. Give yourself from now until the end of the year. It can be dynamic. If things change, you can tweak it a little bit. But at this point in time, I'd say tranche it out, maybe 3 tranches, 4 tranches, and over the next 6 to 9 months.
Okay, value ratios, PE, PTBV, etc. for most equities are still very high. So does that mean that they are still overvalued and hence we have some ways more to fall?
Okay, good question. On PE ratios, I think that is completely, it is no point looking at PE ratios at this point in time. Because as I mentioned earlier, earnings, no one can forecast earnings, so you don't know what the E is. So in times such as this, and as we've seen in investment history, in periods of crisis, most people rely on price to book or discounted cash flows. PE is not relevant because we can't forecast PE, the earnings component, with any level of confidence. So on the price to book basis, actually a lot of countries are trading at close to GFC levels in terms of price to book. There are stocks as well, both in Malaysia and outside of Malaysia, that are trading at close to or some even below the price to book valuations that they traded at during the global financial crisis. Now, I just want to caution you that you don't just look at stock A and stock A is trading at below 2008 price to book multiple, therefore stock A is cheap. You must also understand and look into what the business is like, what the industry is like, because the industry dynamics could be totally different today than what it was in 2008. Example would be in the DRAM space. In 2008, I think stocks like Samsung and Hynix traded 2.6, 0.7 times price to book. Today, at 1 to 1.1 time price to book, in my opinion, it represents good value, even though it is higher than the 0.7 times it traded at during the global financial crisis. And the reason why I believe that is because today there's only 2 to 3 main players in the DRAM space, and therefore the volatility in the price of DRAM is much less than what we saw during the 2008-2009 period. So you have to look at each sector and each stock individually to better gauge whether the price to book represents good value already. Because as I said, industry dynamics are different today than in previous crises.
Okay, the next question, if the market do not go down as expected, what indicator will trigger for you to employ your remainder 20%?
The key obviously would be COVID-19. There are a lot of other things a lot of other indicators that we look at. Fund flows would be one. If we see a resumption of fund flows, we look at the sentiment indicators. If we see sentiment indicators currently extremely bearish, if we start to see it moving higher, we would deploy. A lot of other things we look at, including credit spreads. If we see that credit spreads in the bond markets are starting to narrow, to compress, we would also deploy. We look at volatility indicators such as the VIX, which we track on a daily basis. We start to see it come down, and which it has in the past week or so, come down lower and stay lower. Those are some of the signals that we're looking out for to deploy monies back into the market, or more monies back into the market.
Okay, do you think Affin Hwang World Series Global Health Science Fund will benefit from this outbreak?
Sorry, I won't be able to answer that because I don't know the fund myself personally. It's a fund that we feed into an externally managed fund. Maybe you can take down the question. My colleagues at Affin Hwang, 9 or 10, and we'll revert back to you offline.
Sure, no problem. We move on to the next question. So you mentioned you begin to cover short positions. How significant are your short positions?
That only applies for certain portfolios. The typical retail unit trust funds were not able to hedge using futures. That only applies to very specific portfolios. I'm not sure whether you carry them, but assuming you do, it is very dynamic. Over the past 3 weeks, we have been either fully hedged, meaning we had net 0% exposure to the equity market. At one point, we were completely unhedged, meaning we had total exposure of 60 to 70% into the stock market. But as we speak today, we are probably about 40, 50% hedged. So given our funds are about 75% to 80% invested, our net exposure to the equity markets for these funds is about 30 to 45%.
Okay, maybe we will take another 3 questions. I will just choose selectively because it's already about 8:37 p.m. now. So the next question is how's the COVID-19 impact on the 5G adoption?
I think the 5G theme is one we believe has got a long runway. So it is a theme that we believe will be a multi-year theme. But clearly, in the current environment with the COVID-19 pandemic, it will be delayed. So what we have seen is people clearly, given that they don't have jobs or they are fearful of their jobs, they're not going to go out there to spend on a new 5G enabled phone. So a lot of the analysts have come out to revise downwards their forecast for phone sales. Previously, they were expecting positive overall mobile phone sales growth for this year, but they've come out to revise down their expectations. In fact, for Apple, I think analysts have revised down Apple iPhone sales to negative 11% for 2020. So the adoption of 5G phones would be delayed because people are not just going to go out there to spend on new phones. It will be delayed until COVID-19 passes. But again, I remind you, some of the stocks that are exposed to these themes, the share prices have also come down. So if you're prepared to look beyond this period of COVID, some of them represent good value.
So last Friday, Managing Director of IMF mentioned that we are entering into a recession. Do you have any thoughts on this?
Yep, correct. We are in a recession. It is no surprise to the market. I think we'll have 2 quarters of recession. I'm not sure whether there'll be a 3rd quarter of recession, but we are already in a recession and we will be in a recession in the 2nd quarter as well. So that is no surprise. I want to emphasize again, stock markets are forward-looking. If you wait until they announce that GDP figures, it's a backward-looking indicator. So as far as we're concerned, we are in a recession. Our view is that this recession should be short and sharp. It'll be a technical recession of 2 quarters, but markets have already expected it. So it's not a surprise to markets. It will only be a surprise to markets if this recession drags on from 2 quarters to 3 or 4 quarters and evolves into a great recession.
I see. Okay, final question. What is your outlook for ASEAN markets?
Okay. I think within the Asian markets, our preference is clearly still with the North Asian markets. And when I talk about North Asia, it will be China, Hong Kong, Taiwan, and South Korea. As far as the ASEAN markets are concerned, I think it is a region that we are not so positive on at this point in time, given the current environment whereby with the exception of Singapore, a lot of the ASEAN markets are operating on budget deficits. A lot of the ASEAN markets may not have the resources that some of the larger countries have to manage the COVID crisis. That's one. And secondly, with the exception of Indonesia, perhaps, a lot of the ASEAN countries, the domestic economies is small. They don't have a huge domestic population base that can offset the weakness in the external environment. So from a relative standpoint, ASEAN markets is not our preferred region at this point in time.
Okay, I think that will be all for the Q&A session. Thank you so much, Mr. David Ng. Okay, thank you everyone for joining this
Welcome.
webinar this evening. So I saw some comments that someone experiencing audio issue. No worries, we are recording this webinar. So if you have any audio issue and you would like to replay this webinar, please email us at investhelp.my@fundsupermart.com for the recording. Okay, so thank you to Affin Hwang Asset Management also for making this webinar possible. And thank you everyone. Stay safe, and until we see you in the next webinar, have a good evening.
Thank you.
Thank you.